It's such an easy concept to assess.
That was Warren Buffett on the idea of a company buying back its own shares. Buffett has stated that he won't use Berkshire Hathaway's cash to buy back their own stock unless both he and Charlie Munger agree it is undervalued. For a long time, Berkshire never repurchased its own shares, presumably because they always saw better opportunities in the market, or they just preferred to build up their massive stockpile of cash. In 2018, they finally dipped their toes in, repurchasing more than $1 billion worth of their own stock. In their 2019 fiscal year, it was almost $5 billion. And over the last 2 years, they've spent more than $50 billion on buying back their own shares. Did they change their tune about buybacks? Lower their standards, perhaps? Did they go too long without being able to find enough other places to deploy their rapidly growing capital? Did they perhaps start to realize how overvalued pretty much everything was/is? Were they cleverly anticipating the coming inflation and realized how imprudent it would be for them to keep all that money in cash? Their cash position had been building up rather significantly over the last decade, at a much faster clip than they've been able to invest it, at least. In fact, it wasn't until this year that we've ever even seen a meaningful decline, at least over this last decade, in their cash position. We'll hear what Buffett has to say coming up. Welcome back, you brilliant 17,000 subscribers. Thank you for being here. I'm sure you understand how share repurchases work and why they can be a bullish sign for the future of a stock. When a company is buying up their own shares, they are reducing the number of shares outstanding in the market. They are reducing the number of slices of the whole pie. If there were 20 slices and you owned 2 of them, that actually represents an ownership of 10% of the whole. Now, if the company sliced up the same pie into 10 slices, because they bought up the other 10, as long as you didn't sell any of your shares, you still own 2. But now, that represents an ownership stake of 20% of the whole. 2 of 10 instead of 2 of 20. Buffett simplified the scenario for Berkshire investors by tying it back to the Buffett-Munger lemonade stand. Here he is.
If we had a lemonade stand and Charlie and I and you owned it, and the lemonade stand was making us about $1 a week or something, and we divided it up, and you said you wanted to get out. And if you said one number, we'd have the funds in our little lemonade company, and we'd buy you out. And if we didn't like the price, we wouldn't buy you out.
Now, there are absolutely examples of where this practice of share repurchases can appear, at least, to be a bit nefarious. For example, if some large corporation indiscriminately received some stimulus money or something like that from the government, and then they used it to buy back their shares, well, maybe it turns out they didn't really need that extra money after all. In general, stock repurchase programs are purely for the benefit of shareholders, but they really should only be done if the company cannot find a better, even more beneficial way to employ that same capital. On one side, you have the price of the company's stock. If it's overvalued as a shareholder, I don't want them wasting money on their own expensive stock. The more undervalued it is, though, the more compelling the case will be for them to scoop up as many shares as possible. On the other hand, you have to consider what the company in question is otherwise able to do with this money. How else could they invest? How else could they employ this capital? It's similar to a dividend in that way. If a company like Google, for example, believes their shareholders are going to get the best bang for their buck by investing their capital into innovation and further development of their existing business lines and projects, then that's arguably what they should do. If a company is maturing and or generating more cash than they know what to do with, and here's an important part, that seems likely to be their story going forward, a consistent dividend might be what's in shareholders' best interest in that case. But if they find themselves flush with cash and that situation is perhaps just temporary, as is arguably the case here with Berkshire, buybacks might be the answer.
If somebody had offered us $50 billion worth of stock at a certain point in the last 3 or 4, 5 months, we'd have taken it. It's that simple. It's something that when we can do it and we know At least we think the probabilities are very high. We certainly believe it in terms of our own evaluation and our own investment. If we think that we're improving things for the remaining shareholder, we'll buy it back. And if we don't buy it back. And if we have the choice of buying businesses that we like or buying back stock, controlling factors how much money we have, we'd rather buy businesses. And so it isn't, we don't stay awake at night working out formulas or anything of the sort.
Buffett goes on to explain, one, how Munger has greatly profited from this strategy in the past, the strategy of thoughtfully issuing and buying back shares, and two, why they won't be able to ultimately buy back all that much of Berkshire.
Charlie, I think, spoke the other day in connection with Henry Singleton. I think he bought back 89% of the company over time. And he'd sold stock like crazy, or issued it much earlier when it was overpriced. And he bought it back underpriced. But the key to that, of course, is having people think you're wrong in doing it. So he was able to buy a ton of it. And there's some other companies that have bought a ton of it. And Berkshire isn't going to get the chance to do that because if people think we're buying, we've got sensible shareholders, is what it amounts to. If we had the same group of shareholders that own two-day puts and they were our shareholders, we'd buy back the whole company, in a very short period of time.
Now, while many finance writers and academics seem to make some of these issues very complicated, Buffett has a way of finding as many analogies as he can to help simplify the way he's thinking about all of this. Here was another analogy he gave for the idea of share repurchases, this time with farmland.
Now, imagine if you owned a farm and you had 640 acres and you farmed it every year and you made a little money on it and enjoyed farming, and somehow 20 or so years later it had turned into 1,100 or 1,200 acres. I mean, you'd say, how long has this been going on? What could possibly be, is this un-American or whatever it may be? I mean, is it, sensible use to meet its cost of capital, blah, 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 blah. And if you do it at the right price, there's nothing better than buying in your own business. It is the simplest thing in the world. And then I read all this stuff. It is unbelievable how people can't figure out something that, if they owned a farm and the guy next to him had a farm and somehow you were getting more of his farm all the time without putting up any money while you farmed your own farm, that at least if you're using some of the earnings for that, you'd feel very good about it.
And of course, he's right. If my business was publicly traded, I would view it in the exact same way. Not all managers do. So something you might want to keep in mind when evaluating a management team. Many succumb to these outside pressures and criticisms, one way or the other, buying shares when they're obviously overvalued, or investing in something else when repurchasing undervalued shares would have actually been the most prudent decision. I especially loved Buffett's real-world examples of the value of repurchases in action with some of the companies Berkshire owns today. We'll start with his explanation of this playing out with their stake in Apple, and then we'll watch my favorite, which was his description of what has happened with their stake in American Express. Check it out.
I mentioned use Apple as an example of how our interest in Apple, every time a company that earns $100 billion a year, it means that our interest in it goes up 0.1%. We've added another $100 million to earnings. Well, it takes a lot of work to $100 million to earnings. And in the first quarter, they just reported. They're on a fiscal year, but they just reported their March quarter, and they earned more money, and they had fewer shares outstanding. And we actually bought a little more Apple in the first quarter. So we decided we wanted to own a greater interest, And on top of that, we knew that we would own an even greater interest if they kept buying in their shares, which we didn't have any insider information or anything, but certainly would seem the way to bet. And we feel better because we bought the shares we bought in the market, and we feel just as good as by the fact they used their cash to buy out some of the other people. We owned in 1998, this is more than 20 years ago, we owned about 150 million. I don't know whether they've split, whatever it is, if they split it, split adjusted, but we owned 150 million shares of American Express. I think we bought our last share in 1998 or something like that. So, and we then owned 11.2% of the American Express company. Wonderful company. And since then, they've sent us a check every quarter as a dividend. And so we've taken some cash a little bit as they've gone along. And now we own 20% of American Express. That's what's happened because they've repurchased shares. That happens to have worked out extremely well. If they overpaid for the stock and all that, it doesn't solve every problem, but it's a wonderful thing if you've got an asset you like and they take your ownership interest up. And like I say, we've gone from 11.2% to 20%. If you're using your American Express card, or whatever it may be, 20% of whatever earnings are attributable to our interest, and they used to be 11.2%, and we've done it without putting up any money.
Pretty incredible, right? Bought his last share in 1998, been collecting dividend checks ever since, and now owns a significantly larger piece of the American Express pie. Sounds like a pretty sweet deal. What do you think? Let me know in the comments. Now, although I've learned a ton from Buffett over the years, I don't always agree with him. Here, I'll link out to a super old video I put together of one thing I think Buffett is seriously wrong on. I hope you find it helpful. I appreciate you so much. Take care.